everyone, this is Cherry Chan from Real Estate Tax Tips. I'm on a mission to become the Google Map for hardworking Canadians seeking financial freedom. And today's topic is the most commonly asked question that I get: whether you should set up a corporation to invest in real estate or not. Well, as it turns out, it isn't as simple as it sounds. It's not like, well, you own 5 properties, so I set up a corporation. It isn't as simple as a myth like that. I've heard also if you own 3 properties, then it is time for you to set up a corporation. But the reality is you only get the benefit of setting up the corporation if you own all these properties inside a corporation. So now at the end of the day, it all comes down to the 5 decision factor that I often use to go through with my clients and prospective clients. I want to share those 5 decision criteria to help you understand whether you should set up a corporation or not. If you find the video useful, make sure you give us a thumbs up and share it with your investor friends as well. The number one questions that got asked by fellow real estate investor is whether they should set up a corporation to own their long-term real estate portfolio. Well, this really goes back to the particular investor's goal and priorities. And it also goes back to a bunch of factors that we are going to go through in detail with you. Now, the first one is, what is your investment strategy? What is the investor's investment strategy? It matters. The reason why it matters is because some strategies are taxed as income and some strategies are taxed as capital gain. What does that really mean? So for example, if you do assignment deals and you have the intention to purchase secure a property on contract and turn around and flip it to someone else, those are called assignment deals. If you buy a pre-construction condo or pre-construction home and you secure the property on paper and you turn around and resell it to someone else, that is called assignment. The profit from assignment deals, they are considered income. 100% of the profit that you make would be taxable, and it might even be subject to HST. Now, income that you make from doing flips, if you purchase an older home and then you renovate it up and you turn around and flip it to an other investor or another real estate purchaser, the profit that you make from the property is also considered 100% income and 100% taxable. Now, if you do land development, infill development, you build a house and then you sell it immediately after you finish building it, that would also be considered profit. The income that you make would be 100% taxable. Some rent-to-own strategies, because of the contract signed at the beginning when you purchase a property and you immediately sell it, rent-to-own strategies is designed with the intention to sell the property to the tenant buyer. So all these strategies that you're using in the real estate investment world, profit that you are making from these strategies are considered income. 100% of it is taxable. So if you are using these type of strategies, the best way to set up your structure is to earn these income in the corporation. You report them inside the corporation. They are considered active business income, and therefore it's only taxed at 12.2% in Ontario. Now, on the other hand, if you do anything long-term buy and hold, so long-term buy and hold on student rental, long-term buy and hold on multi-residential, long-term buy and hold on a single-family home, long-term buy and hold on condos, long-term buy and hold and rent it out for commercial properties, commercial plaza, industrial plaza, office condo, these are all long-term buy and hold strategy. If they are long-term buy and hold strategy, then it is less favorable to set it up in the corporation necessarily, just purely based on that investment strategy. Okay, number 2, the second reason. Typically, I ask my clients, do you want legal protection? Some clients are like, well, I got property insurance, I got like third-party liability insurance, why do I need legal protection? And plus, what are the odds that I get sued by the tenants or anyone on my single-family home? Well, the reality is you don't know what you don't know, and the insurance company out there, I'm not saying anything bad about them, but insurance company out there are also profit driven. When you file a claim, they would go through all the disclaimers and all the fine prints in the contract that you sign with them and see if you comply with all of them to determine if you are eligible. Let me tell you a story. My friend owns this particular single family home. Her dad has been living there. She's on title owning this family home. Her dad has this dog, and one day the dog ran out of the gate and chased after the neighbor's little dog. And the neighbor saw the big dog coming and ran back home quickly with the little dog that she owned. And she tripped and fell on her own property. Few months later, fast forward, she got served a paper suing the dad, who's the occupant of this particular property, not tenant, but the occupant of this particular property, as well as the homeowner. So my friend also got served the paper. The neighbor is going after them for damage lawsuit because she's hurt herself and she's now being traumatized. She's claiming for a lawsuit for about $1 million. I used to think that, well, once I have my insurance and everything is covered, but having that corporation separate legal entity to own the properties for you provide an extra layer, an extra peace of mind to protect you further, because corporation is a separate legal entity, and if anything goes wrong with the property, you could also be protected. You may be losing the properties that you're holding within the corporation, but at the end of the day, you're only limiting your risk within what you own inside a corporation. The third criteria to decide how many properties are you planning to buy. Are you planning to buy more than one property? What's your long-term goal? Here's the thing. Corporation setup, corporation structure, or even in the future, if you talk about family trust structure, they all cost money. If you're only planning to buy one single family home or one single family home condo, and there are no other reasons, you're not concerned about legal liability like we discussed earlier, you're not concerned about your money is not coming in from your small business, maybe there is really no reason for you to set up one corporation which costs couple $1,000 to a few $1,000 depending on who you set it up with. There's really no reason for you to set up a corporation to own that particular condo or that single family home if you're only really going for one. And there is ongoing maintenance costs with annual filing of your corporation, annual government filing on top of the CRA return. There is a corporation filing return that you would have to do. So there are different types of filing obligations. And then there is the cost to operate your bank account. There's the cost associated with your credit card. And there's all these costs, additional costs and time and management that has to be added to maintaining a corporation and maintaining a business. So if you're only planning to buy one property and it is a single family home or a condo and the money is not coming from your small business, there may not be a lot of reason for you to set up a corporation to own that particular property. But on the flip side, if you're saying, hey, Cherry, I am going all in and I'm going to retire myself in 5 years and I'm going to buy tens of properties, then if you have a big goal, you may want to set yourself up at the beginning with multiple corporations to begin with, to buy multiple properties, to leverage multiple corporation structure. So this is a determining factor because the filing cost can be spread among multiple properties. Every time you add one more property inside the same corporation structure or inside the same corporation ownership, cost of filing is increased incrementally per property. Not double, not triple, but just increase by a few $100s per additional property. It makes sense to set up a corporation if your long-term goal is to buy multiple properties. But if your long-term goal is just to buy one, like I mentioned before, it may or may not make sense to set up that corporation. Hey there, sorry to interrupt the video. I know you're learning something valuable and I love sharing strategies to build wealth and achieve financial freedom with you. But if you want to learn even more wealth building strategies from top experts like Derek Foster, Jesse Itzler, and if you want to achieve financial freedom faster so you can finally live your best life, then I highly recommend that you save your seat at the upcoming Wealth Hacker Conference that's happening on November 12th, Saturday, 2022, live in Toronto. Whether you are a real estate or stocks geek like me, or you are a crypto head, or even a business owner or aspiring entrepreneur, grab your tickets now because we'll be sharing all the best practices for building wealth across these asset class at the Wealth Hacker Conference. Come November 12th, live and in person in Toronto. Number 4 factor, do you own a small business in a corporation? So small business corporation tax rate is about 12.2% inside the corporation. So if your small business is netting $150,000 per se, you really only need to pay 12.2% tax. I'm talking about regular, could be brick and mortar, could be consulting, IT consulting, it could be advertising agency, it could be accounting firm. Our business profit is only being taxed at 12.2% inside the corporation if I own my business in the corporation. So let's use myself as an example. My business is owned in the corporation. Let's say if I net business income inside the corporation after I deduct all my expenses, about $150,000. I pay my corporation tax, which is equivalent to $18,300, and I have net profits after tax, $132,000, roughly $132,000 available. Now I pay myself a dividend, which equivalent to about $5,000 a month to support my family, and so I only pay out $67,000 to cover my expenses. Now, after all these, I have about $64,700 to be exact, to invest within my corporation. If I choose to invest within my corporation or within a corporation structure, I have $64,700 to invest within 1 year. If I choose to invest in my personal name, I have to take that $64,700, take it as dividend income, report it as dividend income on my personal income tax, which then I would pay more personal income tax first. I would not have $64,700 available. I will have maybe $40,000 available to invest in my personal name. Instead of paying the money, the extra $24,000 to the government as personal income tax, I would pay myself. I would not take the $64,700 out. I would just invest using that $64,700 directly inside the corporation. This means that I'm essentially using the money that I would otherwise pay to CRA, the extra $24,000 personal income tax, I save it and I use it to invest in the corporation, invest for myself and generate income and generate return for myself. So what it really means is that if you have a small business corporation, you're paying small business tax rate and you have the funds available within the corporation to invest for you, it makes total sense for you to buy properties and invest in real estate using your after corporation tax profit within the corporate structure. It will get you to your goal a lot faster because you're using CRA's money to invest for you. Okay, the fifth criteria to determine if you should set up a corporation or not is what's your long-term plan? Are you planning to leave your real estate portfolio to your next generation? I've talked to so many real estate investors, and some real estate investors were like, well, I am all leaving my estate to my next generation, so then they are covered. I don't have to worry about them. So typically, if you are leaving your asset portfolio to your next generation, accountants generally would help you do something called an estate freeze. So essentially, an estate freeze is to freeze the assets that you currently own at current fair market value and pass on the future growth to your next generation on a tax deferred basis. So this type of estate freeze tax planning to pass on your portfolio to your next generation on a tax deferred basis typically involve something called estate freeze, and estate freeze typically involve the use of a corporation. Now, if imagine you own all your portfolio, like 10 properties, all in your personal name from the beginning. Everything is in your personal name. For you to transfer all these 10 properties into the corporation, if you think about it, the cost of transferring the properties from your personal name to the corporation, the minimum is the land transfer tax. The land transfer tax that's being triggered calculated based on fair market value of the property at the time of the transfer. So if you purchase the property for $300,000 and you want to transfer the property to the corporation now, and the property is worth $1 million, you have to pay a land transfer tax of $1 million in today's fair market value when the transfer happens. And you also have to pay the accounting fees to do the tax-free rollover for you. You also have to pay the lawyer to do the transfer for you. So there are a lot of fees involved, but the most expensive fees involved is the land transfer tax, and you would not otherwise need to incur. So maybe sometimes it's cheaper to set up the corporation right from the get-go if you have the long-term goal of leaving your estate, your real estate portfolio to your next generation. And on the other hand, if you're like one of the other investors that I talk to, they don't care if they leave their estate to their next generation, to the kids or to their grandchildren. They don't care. They just want to enjoy what they built or their own fruitful estate. They will spend them all. Their plan is to just spend them all. There may be less reason to set up a corporation to own their real estate portfolio. We just went through 5 decision factors that I routinely go through with my clients to help them determine whether they should set up a corporation or not. And as you can tell, there is no one size fits all solution. We need to understand your priority, your situation, and consult with a professional accountant. Or if you don't have an accountant, by all means reach out to our office and we would be gladly help you understand the pros and cons and the costs associated with setting up a corporation. And if you become our clients long term, we would even help you hold your hands through the whole process of owning properties through corporation. If you liked the video, make sure that you hit the subscribe button and give us a thumbs up, and let us know below too if you have already set up a corporation and how you're using it, because I want to learn, and so then I can provide more information in the future YouTube video to help you use your corporation and leverage your corporation better. Until next time.